When your annual income crosses seven figures, your tax strategy can be reactive. It has to be engineered. After 2025, when the temporary rate cut expired, the top federal individual rate returned to 37%, while the C corporation flat rate stayed at 21%. That spread creates one of the most powerful planning opportunities for high earners who use multiple entity and trust to avoid taxes, but to control how and when income is recognized. At this level, you are not just competing with other taxpayers, you are competing with policy. Every dollar you earn can move through a different path, and each path carries its own rate. The top 37% is real, but for the right structure and timing, your blended rate can settle closer to the mid-20s, all within the law and under IRS rules, designed for legitimate business activity. So today in this video, we are going to talk about how high earners, those earning over $1 million annually, can legally and strategically design their own effective tax rate. If you are an entrepreneur, investor, or professional running multiple entities, this video is especially for you. I will break down into 6 parts so you always know where we are and what's coming next. So part 1, the 2026 landscape and what's changing. Part 2, the 3-layer structure, the S Corp, C Corp, and Trust. Part 3, client case story from Austin, Texas. Part 4, how to implement this step by step. Part 5, how to stay compliant and agile. Part 6, a bonus strategy that takes this concept even further. Stick around to the end because this structure could easily save 6 figures in taxes if implemented correctly. Let's step into part 1. Let's start with the foundation. In part 1, we're going to understand the 2026 landscape and why this conversation matters right now. The top individual tax rate has climbed back to 30.7%. Meanwhile, the corporate tax rate remained at a flat 21%. That 16-point spread is what gives us room to engineer your effective rate, but only if you understand the rule of the game. Now, before anyone jumps into creating new entities, here's the reality. That 16% point difference is not free money because C Corp profits are taxed again when distributed as dividend. So your actual rate can climb back up quickly if you don't plan your timing and purpose. So what changed that matter most to high earners? First, the alternative minimum tax threshold rose, but big deductions like accelerated depreciation or incentive stock options can still push you back in. Second, the qualified business income deduction still applies for many non-service businesses, but personal service firms, I think, like doctors, consultants, attorneys will see tighter limits. Third, trust brackets remain extremely compressed, hitting the top rate at about $15,000 of taxable income. The bottom line, you can't just react to these rules. You have to design around them, and that's exactly what we do in the next part. Transition, let's go to part 2, transition to designing and framework. So now that you know the landscape, let's get into how you actually design your income flow. So this is part 2. So there are 3-layer framework that we want to cover today. So the S Corp, the C Corp, and Trust. As we go through each one, think about which of these layers you already have and which one might be missing. So think of your income like water flow through 3 channels. Each channel serves a different purpose. So one handles activity income, one holds and reinvest profits, and one protects assets and manage long-term distribution. Let's look at the layer number 1, so the S corporation. This is where your main business operates. You pay yourself a W-2 salary that's reasonable, let's say $400,000 for a consulting firm, bring it in over $1 million. The remaining profit flow through as S corp distribution, which are subject to self-employment tax. That one move alone can save tens of thousands each year in payroll taxes. Layer 2, the C corporation. This is your holding or management company, a financial warehouse that receives management fee, licensing income, and intellectual property royalties. It pays at a flat 21% rate and can retain earnings for legitimate business growth, like purchasing new equipment, funding marketing, or investing in real estate. But there is a critical rule that you must have a documented business reason for retaining those profits, or the IRS can hit you with accumulated earning tax. Your layer 3. So the trust. This is where your estate planning and family tax strategy meet. Our non-grantor trust can receive dividends or rental income and distribute it to multiple beneficiaries, each in their own lower tax brackets. The trust itself pays high rates quickly, but the power lies in the ability to shift taxable income across generations. Each layer needs its own EIN, bank account, accounting system, and written agreement between entities. Without those, the entity structure collapses under audit. Now that you understand the 3 layers, let's make this practical. So in part 3, I will share a client story that shows exactly how this framework works in life and for a couple who face the 2026 rate increase head-on. So let's look at Kai and Anna in Austin, Texas. So Kai and Anna are a married couple in Austin. They run a high-end business consultancy and invest in rental properties on the side. In 2025, their combined net income was about $1.9 million, mostly from their consulting business. All it flowed through their personal tax return, taxed at nearly the top 37% rate. When they saw the 2026 changes coming, they decided to act before the bracket reset. So step 1, restructure the business. They converted their design firm into an S corp. Each took a $350,000 W-2 salary supported by market data, and the rest as S corporation distribution. That one moves along reduced their self-employment tax burden by about $28,000 annually. Step 2, build a C corp for intellectual property. They had developed a unique design process and trademarked content. We transferred that IP into a new C corp that licensed it back to the S corp for a fee. The C corp retained earnings to fund expansion projects and buy equipment, all supported by written agreements. Step 3, establish a family trust. They created a non-grantor trust for their 2 children. The trust owned part of their rental LLC and received income from it. So those distributions were taxed at the beneficiary lower rate, bringing down the family overall effective rate. After just 1 year, the outcome was clear. Their effective rate dropped from nearly 37% to about 26%. They invested an extra $180K into their business and saved for their children's college fund, all fully documented and IRS compliant. Now, let's move into part 4, how you can apply the same structure. I'm going to walk you through 7 concrete steps that you can discuss with your CPA and attorney. Even if you already have an S corp, you will want to follow this because the details make or break the strategy. So in this part, step 1, we want to identify all income sources. Break them down into active, passive, and investment categories. You can't optimize what you haven't mapped out. Step 2, match a type to the right entity. So passive income fit inside an S corp. Licensing, brand, or IP income work inside a C corp. Rental or investment income can be assigned to a trust. Step 3. Create written agreements. Each transaction between entities must have a clear purpose and fair market value. Service agreements, leases, licensing contracts, and management fee terms. Step 4. Open separate bank accounts. Never commingle funds. Each entity must stand alone financially. Step 5. Review compensation annually. Your S Corp salary must be defensible. You want to use market comparable and document hours and responsibilities. Step 6. Plan distribution strategically. So if your C Corp build cash, lend it to your S Corp with a formal loan agreement instead of paying dividends. If you are trust or excess income, distribute before year end to maximize lower tax bracket beneficiaries. Step 7. Create an audit trail. Keep minutes, board resolutions, and annual filings for every entity. If it's not written, it doesn't exist, at least not to the IRS. Now that you got the structure, let's move into part 5, how to maintain it. So this part is where most earners lose ground. The goal isn't just to build it once, it's to adapt and protect it as tax law evolves. Every January, you want to schedule what we call an entity map review. So lay out all your entity, your S Corp, C Corp, trust, partnerships, and confirm, does each field serve its intended purpose? Are these agreements current? Are you still meeting reasonable compensation standards? If Congress increased top personal rates, shift more profit into the 21% C Corp bucket. If dividend tax rises, delay distribution or reinvest profit inside the company. If trust bracket tightens, adjust your distribution earlier in the year. Agility is what separates tax planner from taxpayer. The goal isn't to predict Congress, it's to stay ready for whatever they decide. If you like the video so far, like, share, subscribe. We are now at the final section. This is where the real efficiency happens. I will show you one advanced move that let you use your C Corp as a reinvestment engine instead of a tax drag. Here's how our most sophisticated clients use the system. 1. Their C Corp earn management or IP income and pay 21% corporate tax. 2. Instead of distributing profits as dividends, it lends part of those funds to the S Corp under a written promissory note. 3. The S Corp uses that loan to expand operations, fund marketing, or acquire new assets. 4. The S Corp repays the loan with interest, which the C Corp record as legitimate income. The strategy keeps capital working inside your structure instead of leaking out through taxes. It's fully compliant as long as you document the loan, use market rate interest, and record payment properly. That's how our clients like Kai and Anna kept an additional $40,000, $100,000 circulating inside their ecosystem, compounding growth instead of taxes. I hope you enjoyed the video so far. If you have any questions, have any note you want to share, put it in the comments. And we want to see what plan you have for this year. So we have covered a lot today, the 6 major parts, each building on the left. So now let's bring it all home and remind you why this matters. At 7 figures income level, you don't just track what you earn, you design where it lands. By combining S Corp, C Corp, and trust the right way, you can bring predictability to unpredictable growth. The truth is the 2026 tax work will reward the planner, not the reactor. So if you are a business owner, investor, or family office earning over $1 million a year, start building your architecture now because your tax rate isn't assigned, it's engineered line by line, choice by choice, and strategy by strategy. Thank you for watching. I'm Mia. I will see you at the next video update.